I'm just glad you're not standing there on the podium while you interview me. I feel like we're in like a Golden Globes type of a room or something where somebody's going to trip trying to accept an award later today.
Well, listen, for those who don't know Joel, let me just briefly introduce him. Joel is, in addition to being a good friend for about 15 years,
15 years, yeah.
Joel is co-head of Ares Credit and portfolio manager in the Ares Credit Group. He's also a member of the Ares Credit Group's Alternative Credit Executive Committee and the Alternative Credit Pathfinder Core Investment Committee. So you run the gamut there. Joel has been investing across alternative credit for over 27 years. Prior to Ares, he was a partner and investment committee member at both Fortress and Atalaya and started his career at Citi. He currently serves on several corporate and advisory group boards with a particular focus on global health and education, including Ares Charitable Foundation, Path Global Health, and is a member of the NYU Public Health Dean's Council. Well, join me in welcoming Joel Holsinger.
Thank you.
Joel, a lot of terms, and we were chatting, about private credit, asset-backed credit. Can you define what is meant by private asset-backed credit and how we should think about this market in terms of size and scope?
Sure. I think you did a great job of describing it up there. It's interesting. Normally, you have to go a little bit more rudimentary. I think with this crowd, given we're sitting next door to 7,000 people or 6,000 people at ABS East, it's really simple. It is everything that is done on the asset-backed securitization market is also done on the private markets. And it kind of goes to that slide you mentioned. We have a similar slide, which is you touch our assets every day. And it goes to the size of the market. It's not just the $40 trillion, but it goes to, if you think of direct lending, you think of corporate, that's 5 or 6 trillion. So you just talk about the sheer size and scope of what's going on next door. You talk about the sheer size and scope of what we do. And I think the thing that's really transitioning in our world is that you need to have all three buckets of capital. I think when the thing you're going to look forward on and you're going to see in this market is right now there's a lot of people that have a ton of capital on the insurance side and almost nothing on the private side. And in the gaps, you mentioned it earlier, we actually broke this out because you really have to talk about this market on the rated side, which is really IG insurance driven, and on the unrated. But even on the unrated, there's three pools of capital. There's the insurance solutions, the IG. There's what is core to us with regards to right down the middle. It would be close comparable to kind of the return spectrum you're looking for in direct lending. So call that 400 to 700. And then you have the more opportunistic capital. And I think that, look, we believe we're the only group that has balanced capital and scale across all three buckets. There's parties that have started up that have been in this space for 10 years where they have capital on the opportunistic side, but they don't have the insurance capital. You've seen, obviously, Castle Lake and Atalaya get acquired where they're kind of acquiring themselves, getting acquired so they can actually attach themselves to insurance and other related capital. You've seen, obviously, other players that have huge scale capital on the insurance side that are trying to raise their first ever fund on asset-based. In fairness, most of those funds are more towards the opportunistic. It's not right down the middle or the core portion. So our advantage has really been having scale in all three buckets of capital. And I think that, I mentioned last year, slightly controversial actually at the European conference, that if you're not at $10 billion, you're not going to have a reason to exist. I think that a few people were listening because they ended up getting acquired shortly thereafter with regards to size. And I think that's the thing. This is a world, unlike direct lending, where you're not going to have 10, 20, 30 players. You're going to have 4 or 5. It's not going to be 1 or 2. It's not going to be 10. And I think right now it's pretty stinking clear who those 4 or 5 are going to be because it's those that are attached to insurance capital, but those also are going to have the private capital. And we look at it as our advantage is staying balanced across all three pools of capital, never putting too many of our chips on one side of that table.
Where have you been seeing the best relative value opportunities across those three platforms?
Yeah, I mean, as everyone in this room knows, the ABS market on the illiquid or on the liquid side has been relatively frothy because there has been a lot of inflows on the annuity side. And that does create a feedback loop. You know, that capital coming in this year, and I said it at the end of the year, and I think it's been true, spread has nothing to do with what's happening today. It is all about yield. Everybody is chasing yield because of the end of where rates are. And I think we're still at that transition period, everybody chasing yield. I think we're going to start to see that we could have a period here in the next 3 to 6 months where we still stay in an aggressive market, but spreads actually widen. Because people are kind of ignoring the spread and just looking at that yield, and especially insurance and pensions and others are just trying to grab duration and yield. So on the liquid side, that's driven, you know, we got corporate OAS that's now at a 15-year low. So it's driven things to tights on the spreads. But what it doesn't speak to is that broader transition that's going on. You know, there was the slide up front that talked about what do we expect, and one of the answers was the public to private. I don't think people still get how much that's going to change this world. And we talked about the size of this market versus the size of what's going on over at ABS East. To be really clear, every time a private ABS deal is done, and when I say that, I mean a deal that would be done in the public ABS market that is IG, but getting privately rated by us, Apollo, KKR, a few of the other large players, a deal goes away from the public ABS market. Yep. So it actually is taking away from that market. And what's going to happen over time is it's going to totally transition this market to where you're going to have a huge market that is private rated, exact same risk, exact same rating, exact same structures, but it's getting taken down wholly. It's getting taken down by 1 or 2 parties, as opposed to it getting done by a desk that's getting syndicated out to a large group of parties. And I think that's pretty transformational. Yeah. As much as it's transformational on what's going to happen with banks, as well, you know, as you mentioned, I actually think that's the piece that's getting missed at times on the insurance side. But on the other side of it, there's that much of a large world that's not rateable. There's that much of capital that needs to be brought in scale. And when we look at it, we know there's still so much more growth in kind of the middle or the core sort of market. And that growth is really the part that I think is going to continue to spur the unrated portion.
Got it. Now, where have you seen the most interesting opportunities this year? What were some of the marquee transactions you all were involved with?
So speaking to the unrated or the illiquid side, you know, we've been very active, and we can only, this is on the record, so we can only speak to those that are publicly out there. We do have a deal that will get press release probably today or tomorrow that is a capital relief transaction. It's not in traditional SRT type form. But where we've been active is at the end of last year, we did 2 of the largest SRTs in the market. And then since then, we found portions of that market wholly uninteresting. You know, you've seen spreads come in, you've seen a lot of news, a lot of headlines. There's been a lot of activity. But what we found is that actually doing one-on-one capital relief transactions with banks, where we're actually sitting there partnering with them on a direct basis, that's actually been the more interesting portion, where we can do that on a bilateral basis. The other, and we just published on Friday right before this event, and I think it's the best one I've ever seen out there. It's definitely the best white paper Ares has ever done. We published a white paper on fund finance that got delivered on, and it's on our website, as well as you can see it in some other areas on Friday, on fund finance. But it's not just fund finance, because I think a lot of attention goes to private equity NAV. And I think people don't realize the breadth of that market. You know, one, it's going to continue to scale. The usage is increasing, the market, and obviously the underlying TAM is large, so it's kind of growing with the underlying market. But the thing in that market is, that market has traditionally been sublines and hybrids. Now you've got sublines and hybrids in single fund NAV, and then you got secondaries NAV. And even in single fund NAV, we've been active not just on private equity, but we've been active on real estate, we've been active on infrastructure, and then you can go to GP structured. You know, the GP structured sides we've been very active in. And so when you look at that combination, all of those things are tools. And call it what it is, they're all driven by DPI. I said last week or something, the DPI has to have a new definition, because there's a chart that shows where DPI has been since 2020 for most private equity funds. And I was debating whether it should be disappointing performance since influenza, started in 2020, or just disappointing performance since inception. So it is something that's going to only continue to get driven, by that need and that lack of M&A activity we've seen on the corporate side, but that's a market that continues to grow. On top of that, I'd go to infrastructure assets. I don't think anybody has any clue how big that opportunity is and how there's just not enough capital. When you really look at the scale of this, I went down a rabbit hole a few weeks ago with the team when the 3 Mile Island deal was announced by Microsoft. If you look at that 3 Mile Island deal, 850,000 megawatts, it can it can power 850,000 homes or 5 or 6 hyperscale data centers. So that's 3 Mile Island. If you think of the power need that's there, the bigger opportunity and the bigger scale won't just be the data centers, it's the equal side of what you see on power. And if you were to build a SMR, a mini nuke, power plant, and you were to tie it directly to a hyperscale, it'd pretty much equal 150 megawatts, 150 megawatts. And if you look at that portion of it, that would be net zero. It would also cost you $6 to $10 billion, one hyperscale, one SMR. And so when you think of that opportunity set, not just on data centers, but on fiber and on cell towers, the sheer scale of the capital that's needed isn't just an asset-based credit issue. It's a commercial real estate. We're seeing it in insurance capital, commercial real estate capital, bank capital. We've been involved in a deal that's more capital relief directly with banks where they already have too much exposure to data centers, and they're trying to free up capital for balance sheet expansion so that they can actually do more in that space. And we're not even in the first inning. We're sitting in the batter's box right now with regards to how big that opportunity is going to be. So I'd say fiber, fund finance, capital relief, but on a direct basis, as well as we're still seeing stuff come out of non-core. We launched the platform we bought from City National Bank of Florida, their equipment leasing platform and team, Ansley Park, that we launched last year. And so we think there'll be more of that. Now that you're having the chips settle with regards to Basel Endgame, you're going to have banks decide what businesses they're in and what businesses they're not in. And that's going to create non-core opportunities and things that will leave the bank environment. Because I think the thing that's missed often is when they leave banks, because banks are still sitting here 10 to 20 to 1 levered. If you look at JP Morgan by tier 1 capital, they're 10 to 1 levered. If you look at it on total leverage, you're 18 to 1 leverage. When they leave the banks, that goes on an illiquid, if it can't be put to the ABS market, that goes from 250 to 350 over to 500 to 700 over. It goes to the private credit bucket. It goes to that other pool of capital. And so where that next transition occurs will be very, very telling with regards to the opportunity set.
Right now, I'd just like to play a clip of a song. If we could play that clip, and maybe Joel, you can give me some color.
So we get asked the question all the time about AI. I love this. Oh, wait. Hold 1 second, sorry. So we get asked all the time about AI, and I think everybody in this audience has had too many AI questions. And I think we've all been, blown away by what can be done if you want to really start to see it. And we bought Bootstrap Labs last year at Ares, and we've been starting to integrate that in across different things we're doing on the AI basis. But sometimes the simplest examples are the best examples. And so a lot of people in the room may know Ian Smith, who is one of our heads and a partner across our CLO business on the leveraged loan side of Ares. And he put in some basic parameters on CLO resets and asked AI to put together a song. This is the song.
We're in the CLO reset game, back on the grind. Reading the indentures, gotta get aligned. Japanese banks, got them in our sights. Investors on the edge, watching the heights. Rating agencies call, looking for the slice. Whole market spinning like a roll of the dice. We're doing 5x the work in half the time. Breaking down the deals, every single line. Reset the market, no time.
The scary thing was somebody did that similar with a podcast, and it came back with a podcast. So you basically feed AI with basically a news article, and it comes back with a podcast, and it's pretty good. And it really goes to how transformational a lot of the technology and the pieces are that we're having here. It's not quite Tay-Tay that many of you are recovering from last night, as Kevin Alexander likes to say. But it is also still my definition of hell. As my team knows, I can't stand, I'm not a concert person. But it is pretty amazing where we're sitting on the cusp of. And I think that there's a great chart, it's Wait But Why, with regards to you never know when you're standing here. I always use the analogy, because I'm a history geek, of communism. In 1989, since I'm a child of the 80s, we had no idea that communism was about to fall. Now if you read the history books, everybody writes it like, oh yeah, we knew communism was about to fall. It was this impending thing. Well, I think we all feel that with AI, which is we don't really know exactly where it's going, but we know we're standing on that point. I think that same thing is occurring on two parts of our market. On the liquid side and the ABS side, that transition from public rated to private rated, we are standing here, and it is about to go off. And if you look at on the illiquid side, the capital, the scale, and the consolidation of that capital, we've seen this before. You know, you end up with ETFs. There's two, Vanguard and BlackRock. If you look at it across infra equity side, there's 5 or 6 massive players in that space. And so it's going to be a consolidated, it's going to be who has that capital at scale, who has that capital that's flexible, but it's also going to be who's balanced. Who didn't sit there and put too much capital into one part of it and not enough on the other side, and who wants to sit there and partner with banks and partner with insurance companies and not just sit there and compete against them. Because that's our portion of it, is we know how we win. It is with scale, it is with flexible capital, it is with balanced capital, but the other way we win is to be the preferred counterparty. You know, we like to say that the handshake still means something. And if you think of that handshake still meaning something, if you're just sitting there trying to crush every other insurance company and just print as many annuities as you can, you're not partnering. You know, being able to compete and partner at the same time is a balance, but it's a balance that you have to be able to have. And in the end, we're all partnering and competing, but being that preferred counterparty is what ends up winning out.
In terms of competition, since you can't compete with the Fed, can you talk to us a little bit about interest rate cuts? And you at Ares talk about the physics of interest rate cuts. How should people be thinking about the rate environment and its impact on private credit?
Sure. Yeah, in our last newsletter, and if you haven't checked it out, we have, I think it was 200,000 views last quarter on our In the Gaps newsletter, and it continues to grow. But we take a lot of pride in it. Keith Ashton, who's co-head with myself, is the one who deserves a lot of the credit, but the entire team, and we have a number of people here in the audience today, put a lot of effort into it, and we put a lot of time into it, not just on kind of going inside the data and looking in what we're seeing, because the advantage we do have is that pattern recognition sitting across everything we do and all of the different information. But we also try to say something. We actually try to put our opinions out there. We talked about the weakening consumer 2 years ago with regards to subprime and near prime. It's why we keep getting these conflicting signals as we're sitting here today. But it goes to, in the last newsletter, we talked about the physics of rates, and I always write the path forward at the end. And the path forward, the physics of rates goes to, it's a little harder to do with a hand mic, but it goes to what's been going on in this market for 2 years. If you go back 2 years ago when rates first started to go up, only one market adjusted, resi. The asset yields went up, the liability with the liabilities. Most other markets did not adjust. The asset yields did not adjust to the new liability market in a rising rate environment. And in the end, that ARB, that difference between the assets liability, is what really drives our market and makes the world go round. And what's happened, though, is if you look at the market, it used to be that you had, boring safe, don't even have to really think, just outside of treasuries, I'm making 3% if you go back 3 years ago. And on the upper end, I'm making 25, but I'm doing venture, private equity, other asset classes. And what's happened in the last 2 years is, I think most of this room can probably agree, there's a lot between 6 and I'd say 13, where you don't have to do much to go make 6 because of where base rates are. But man, it's actually really hard to make above 13. What you see on the opportunistic side is you have to be very selective so that you're not doing it through just incremental risk in another way. But that is really just created by the physics of rates. Private equity is the greatest example. There's a reason we're seeing disappointing performance since inception, low DPI, which is, if you go back 3 to 5 years ago, and really for 30 years, private equity had the benefit of declining rates. And with declining rates, what you saw was sublines cost less, your cap stack cost less, you had more excess cash flow, which allowed you to do dividends and recaps, which allowed you to put more money into R&D and into CapEx spend to kind of fuel future growth, and helped with multiple expansion. You know, it helped on that takeout. Now, the physics of rates is that's the friction. That's what's pushing this market down, which is the higher rates, you know, is what's pushing the upper end of what you can kind of achieve, because you are paying higher sublines, you are paying higher on your cost, you're not getting the dividend recaps or dividends off of the business. You are not sitting there and able to put as much CapEx and R&D into it, and you're probably gonna be flat or compressed in your multiple. That happens on every asset class. And I think that the thing is that I normally can be relatively perma-bearish. You know, I'm generally looking and assuming that things are going to go bad because I'm a credit person. But the thing that gives me a lot of excitement is if you look forward now and we start to get rate declines, a whole world of opportunities open up. If you look at us on the illiquid side, where have we been focused? We've been lending. Because why the hell do I want to own the equity when the arb is broken? But what starts to happen is we start going towards owning more. We've done a lot of it in the past, and we still continue to be active, where we can lend against those assets as well as we can actually go own some of those assets, either on a minority basis or on a control basis, because the arb starts to go the other way. So as rates go down, I do think we're going to see some more permanent impacts of some of this. If you go back in history, you know, the thing that is true is that private equity used to be a 1 or 2% check, and then it became a 10 to a 30% check. And by the time you got to the early 2000s, it was a 30% check. Post-GFC, it's been a 50% check, even 60% check. I will not be surprised if real estate has that same impact. You know, banks used to lend up to 70 to 80%, and then you could get some mezz thereafter. Right now, banks will lend to you all day long on diversified large portfolios at 50 to 60. If you look at the Wembley deal we did that was publicly announced, you know, almost $1 billion pref in partnership with Lone Star, that is that recorrection of that size of that wedge. I think that we're seeing opportunities in real estate coming out of this physics of rates, where it's not just, you know, can we do these large prefs or bridges or others, but can we do real estate fund finance? Can we actually lend against the fund and kind of create that opportunity? So as we go through this transition, and I think right now we are in a transition period, you know, all the buyers want tomorrow's price, you know, and all the buyers want today's price, all the sellers want tomorrow's price. And so we're in this situation where we're going to really pick up as we actually get to real rate declines, because right now swaps are pricing it in, but SOFR is still sitting high. It's still lagging. Like, we like to sit here and talk about the omnipresent Fed. To be really clear, the Fed's getting pulled. The market already spoke, and the Fed is getting pulled by the market, and they're moving up and down for that. So these things create huge opportunities that come out of it.
Well, in our last few minutes, can you, I want to switch kind of topics a little bit and talk about philanthropy. I know you all at Ares and you personally are, you know, very committed to philanthropy. How has that been a contributor to the success of the Ares alternative credit platform? And can you discuss some of the charitable connections between Ares and your firm?
Yeah, in our Pathfinder family of funds, and you can see this on some of the public announcements, we now have over $15 billion of capital that goes across the Pathfinder family of funds. And when I joined almost 6 years ago, my ask was to have a charitable tie-in to whatever I did next. And you know, it's been one of the best things I've ever done in my life. You know, I always say it's my second best idea, the best being buying a drink for my wife. But if you look at it, it really aligns why you're doing what you do. And if you think about what we're doing, every deal we're doing on the unrated side is driving that impact. I'm going in 2 weeks along with a number of people in the room from my team. We have about 12 people that are going to India. We went to India 2 years ago. I go to Senegal at the end of the year. Nothing resets my batteries more than those trips. If you see the impact you can have, if you think of global health, the estimates by GiveWell and others is it costs about $3,500 to save a life. So if you think of the capital that we've been able to raise, and it's already accrued over $25 million, and if you just do the math, every $1 billion, if you get a 1.5 or a 2x, you're sitting there having $10 to $20 million of charitable impact. So every deal you're doing is driving this charitable impact, and it's both across health and education. So it goes across developing world, it will go across Europe, it goes across the US. We've made our first grants out of that this year, but it only continues to grow now that we've really got it to scale. And if you look at the next decade, those numbers become amazing. They become bigger than I ever imagined when we had this concept and this was my ask. And so that emanates through the team. If you think of that purpose tie-in and you think about what we're trying to accomplish, one, anyone who went to that trip to India 2 years ago, if it doesn't change your life, something's wrong with you inside. And Wall Street often has that problem of purpose, where, okay, we're driven by the dollars, we're driven by the bonuses, and I'll be the first to say, I'm a poor preacher's kid from Boise, Idaho. In my 20s, I was driven by that. But then you get to a point in your career where you say, and then what? What is it about? And so when you tie it back to every deal you're doing is driving that impact and is driving that broader purpose, and they can see it on the ground in the US and Europe, you can see it on the ground when you go visit developing worlds, that's real impact. We've been talking to some of our peers, and I think they're generally open about broadening that, about making a pledge that would be similar towards health and education to make this a bigger thing. Because I think that if you think of the impact you can have, and whether it's 1%, 5%, 10%, about tying what we're doing, and for the bankers in the room, tying it to the fees, tying it to the pieces, it emanates throughout your entire culture. From the 20s, the 30s, the 40s, the 50s, everybody ends up getting it when they see it in action. And it's changed the way we think about charity at Ares. We formed the Ares Foundation thereafter. We've now made $56 million in grants that have nothing to do with health and education, but across other broader. There's now 21 funds at Ares that have a charitable tie-in above and beyond what we've done from the Pathfinder family of funds. And it changes the way you think about those things. So I would challenge a lot of people in this room, because I look at it as, and I said this last year, but I think it's always true. When you're 85 years old, there's only 3 things that matter. My father's 75, he got diagnosed with Parkinson's 2 years ago. You really start to think differently about life. You really start to think about what matters. And what matters is your close friends and close family. What matters is your experiences. It's the trips, it's not the cars and the houses, right? It's the memories of those trips and those experiences. But it's purpose. And purpose can be mentoring, purpose can be teaching, purpose can be giving your time to charity, purpose can be giving your money to charity. But the main thing is doing something. And I think that it's really resonated throughout our group, it's resonated throughout our organization. And the way we look at it is, it's also part of being a preferred counterparty, because everything we're doing is driving that purpose. And so when you're partnering with us, you're actually speaking for something. You're speaking for something good. And we hope that that starts to become more and more of our brand over time.
Joel, in our last 2 minutes, I'm curious if you have any bold prediction for the next 12 months. I know you all at Ares are not shy about making predictions, also admitting when the predictions you've made, I see you track them when they're not accurate. But what's your prediction for the next 12 months?
Yeah, Kevin Alexander's coming up to do a panel after this, and he cringes when you ask me questions like that on what I might say. I'll go simple. I'll go consolidation is near done. There's nobody left to consolidate. I think that if you look at the platforms and the larger in our space, that's already occurred. And I think that the mapping is relatively straightforward on where this market kind of goes. I look at it as the second one I would say is, I was amazed there was not a single person in this audience that on the quiz on pessimistic. Look, I am more naturally perma-bearish, but I think the only debate left is basically soft landing or soft recession. And so I don't think it's going to be a severe recession. I don't think it's going to be ugly, but we're slowing. And you can see it in the data, and you can see it in the consumer data on the spending side. And we are in a K recovery from the standpoint of prime and super prime. And everybody in this room feels spectacular because we're all doing very, very well because you have 3% mortgages and stock price is up and the market's up and you're invested in it. But everybody not in this room, which is 40% of the US that's near prime and subprime, they are struggling mightily. And they don't own their home. They didn't get the home price appreciation. They're not invested in the stock market. And they got labor inflation in the first 2 years post-COVID, and then they got real inflation thereafter. And so their discretionary income is relatively light. So whether we kind of just barely skate above, but to be clear, a soft landing still means what we're kind of in, which is we might be, as Europe is in right now, we're sitting there in a 0 to 1, 0 to 1.5. I don't think this market is pricing 0 to 1.5. I think this market is pricing perfection in so many ways. If it goes a little worse and we slide into a light recession, as Europe is getting close to across many of those markets, then I think you might have a recorrection. So I think we've been priced to perfection for a long time, and this market continues to take every bit of good and bad news as good news. And I think that we just need to make sure we're sensitive when we're looking at portfolios and we're looking at deals, that it is soft landing or it is soft recession. I don't think there's the growth that we're necessarily modeling in on some of the assumptions.
Got it. And listen, thank you for your time this morning. This was terrific. And join me in thanking Joel Holsinger.